Week 0. This will be the first episode of a series of episodes in which I discuss and reveal trading. And the purpose of this is multifactorial, and I'm not really going to get into it, except the fact and idea that I've seen so many of these and have been disappointed with just about as many as I've seen. And what frequently happens is someone goes and says something like $0 to $100,000 challenge, and then it kind of fizzles out, and then they never get there, and they give up. And just like the news, when something bad comes along, they never announce when everything's okay and life's back to normal. Just like these people never say, okay, I gave up on that. That was a lot harder. It was just a clickbaity idea to get more subscribers to the channel. And on top of that, if that's not enough, they just dump cash loads to try to increase the size of their portfolio because everybody's impressed by big numbers and don't really care about percentages, which is why any of these common people that you might know of on the financial YouTube spaces always talk about how they put $15,000 towards this stock, exclamation point. And it's like, don't you have like $1 million portfolio? Like $15,000 on $1 million portfolio is 1.5%. That's not too impressive. It's almost a rounding error, not quite, but almost. But the small timer hears $15,000 and they're like, wow, a lot of money. And then the big timer knows the deception. They have the intention to deceive, even though they're being factual and representative of the dollar denomination that they're investing. They know good and well that it's, well, practically a rounding error. So it's a lot easier to grow a portfolio from $0 to $100,000 and then say, well, I'm going to put $1,000 in it a month. But then, I don't know, once a quarter or once every 2 quarters, they dump in $5,000 or $10,000. And then the strategies always change. It goes from a dividend portfolio to a growth portfolio to this, to that, to options trading. And you can almost see the struggle in real time. Like, I don't know if they don't know better, but to see the trajectory and development and the different things they're trying out, it seems to me that they didn't have enough foresight to realize the difficulty of growing something from, say, 1,000 to 100,000. And I've been constantly frustrated. They don't show you in real time, the majority of them, what it is that, well, not real time per se, but they don't keep up on it. And they just leave you behind to seemingly wonder. And then, like I said, they grow the portfolio in a very haphazard fashion, and then they normally just give up. So I don't want to do those things. I would like to at least stick with this for, say, a year. And so here we go. This is where we're at. This is pre-game. This is ground zero. Week 1 has not begun. Week 1 begins the beginning of the year. So the name of the channel is Cup of Coffee Capital. The point of that is as you'll notice, $42 goes into 7 days a week. That's $6 a day. That's about a cup of coffee. That's the capital that you would use in a cup of coffee. And there's all kinds of thoughts you could do with this, like how small incremental changes can make big differences, such as the $2,184 that even if you don't lose or make any money, you'll have at the end of the year. Not to mention the amount of knowledge that you will have gained and hopefully some nuanced, contextual, detailed understanding of markets instead of some conspiratorial-minded, ignorant, uneducated perspective from haphazard collection of confirming information. And maybe you can be more wise at the end. Even if we lose half the money in this account, that's what, $1,092? So we'll still have $1,000. So each week I will put in $42. No, not once a quarter I'll throw in an extra grand. And no, I'm not withdrawing money from the account either. So this is where we're at. I wanted to make sure to get all this set up because I've had already technical difficulties. So I'm making this video now. This is, let's look at the date here. December 22nd. And I'm just getting the ball in motion. I'll probably, I don't know, either do it every Monday or every Friday. Not really sure which. Probably starting the first week, I'll do it every Monday. And on top of that, I might do some other side videos as well, just to discuss and speak of things perhaps, but we'll see. But the once a week upload will happen. Because I don't have to buy stuff. And that's my game plan, after all, is to buy stocks, buy securities. Shout out to TJ Macro, as you'll notice on the bottom right hand corner. If you don't follow him on Twitter, you probably should. Before buying options, slam your hand in a drawer and then don't purchase the options. So this goes into some loose, we'll call them rules, that I plan on conducting myself with. I don't plan on buying options. I don't plan on buying puts. I don't plan on buying calls. I have entertained the idea in my head of selling puts and selling calls, because a good way to degross, and this will be sometime in the future, even if I buy $4 stock, to sell a covered call means I need 100 of those, which means I need $400, which means I need about 10 weeks worth of investing. And that's 2.5 months from now. So I don't want to put the cart in front of the horse. But I do not plan on buying puts. Now that doesn't mean I won't try to be sneaky, as we'll get into in a moment. But I just plan on buying securities, basic stocks, nothing fancy. And I was getting ready to say that degrossing, say at some point I think some market volatility might come up to the downside, and I have 100 shares of a security, and that security is $4, let's just say, doesn't really matter. Oh, it does. And I'm afraid that the stock is going to fall. I can sell out of the money calls, let's say for $4 and collect a premium of 20 cents. That would protect my downside of 5%, because 20 cents times 100 is $20. I have $400 worth of stock, so my stocks can fall 5%. And I'll be net neutral once you factor in the premium. That's a way to conduct oneself if they don't actually want to degross and sell down their position because they think some turbulent times are coming up. So that's about all I have to say on the options dynamic. So, anyone who's been in the stock market or has paid any attention at all knows that this year the indices are down 20 to 30%. Unless you're some of these pump and dump, Ponzi, fraud, unprofitable, high price to share, high price to earnings type companies, and then you're probably down 50, 60, 80%. But that doesn't mean that there's not sectors, there's not industries, and that there's not particular stocks in the market that are actually doing well. You'll see Elf Beauty, Scorpio Tankers, Ulta Beauty, and Tidewater up anywhere from 10% to 286%. Now that doesn't mean that next year they'll do this type of performance, and it doesn't mean last year that they did this type of performance. But what this is indicative of is a more abstract idea, which is that if one can, which I'm not saying I can, but if one can conduct themselves in a fashion that sees particular developments in the market, you can take advantage of those while minimizing yourself from the laggards in the overall index that would then drag your performance down, because the S&P has a lot of stocks in it that have either gone sideways or been up on or up on the year. But then you have disproportionately sized stocks like Apple that haven't had the best of time. But then that weighs down everything, being that it's a weighted index. So that's part of our strategy. So now we're not selling puts, we're not buying puts, we're not buying calls, and we're buying individual stocks. And no, I'm not buying crypto. If I want to lose my money on a gamble that blatantly, I'll just go to the casino. So here we have the old Tesla. Now, if you notice, ironically, or interestingly enough, you just can't ignore the juxtaposition that today, me making this, it's down 69% on the year. It's actually up 3.5% after market, because on the Twitter space, Elon says that he's not... I'm not really sure if he's not selling any more shares, he said, or if Tesla's not selling any more shares. But whatever the news is, it's up 3.5%. So yay for them. And I'm not buying things like this. Now, you can say, what do you mean like this? Well, I'm not going to... Well, that's not true. I might. Because why not participate... Not to say that this is a... Why not participate in a stock promote if you can get in early on the stock promote and have asymmetrical risk reward? Now, you could say it's down 69% in the year. Well, to me, it's still expensive. I'm not going to participate in it. And I think there's better things. And I think most of this is an Elon premium, not an EV premium. And since at some point Elon seemingly went from being accepted by the left to being rejected by the left, and since a lot of the ESG, what do we call it, promote and narrative control is no longer favoring Elon, and kind of to see a lot of these investment firms like BlackRock kind of shy away from the ESG thing, I don't think that's going to help Tesla out. And this is a very specific stock I'm talking about, but I said things like this. So if I see one of these taking off, I might get in on it, but I'm not a true believer. I'm not a useful idiot. Just because an industry is doing well doesn't mean that any particular participant in that industry is going to do well. You don't want to conflate categories. And in the bottom left screen, you'll see the TSLS, the Direxion Daily Tesla Bear stock. And this is what I mean by being tricky with my trading strategy. For me to benefit from Tesla going down, as it has recently, I would either need to short... I mean, there's all kinds of ways you could do it. I mean, I could have sold calls. You could outright short. You can buy puts, or you could even sell calls at a lower strike price to collect a premium, hoping it doesn't go down there, and if it does go that low, to roll the puts, so that way you don't actually have to buy the stock. But if it keeps going down, it'll actually... Even this little portfolio can manage to purchase the shares at this the rate it's going. But that's what I mean by being tricky with a trading strategy. If I think semiconductors are going bad, I can buy ticker symbol... Well, I can't remember. SOXL is the triple. But there's a lot of inverse ETFs. And I am more than happy to buy those. And I'm not going to buy stuff like this. I don't want to own... And yet again, you might ask, what do I mean like this? Cross-asset ownership with people like ARK Investment or Tiger or any of the .com Munger funds that are the 2020 Munger funds, let's call them. And I want to touch on this for a moment. I don't even care about the energy part of it. I want to focus on the second half. Meanwhile, many pure play, early stage innovation stocks have dropped below their coronavirus lows. Truth will win out. I'm not even touching Truth will win out. I want to focus on many pure play, early stage innovation stocks. Those 6 words. Because that presupposes that's what's in ARK Investments. Now, let's go look at ARK Investments' top 10 holdings. And let's go through this. What's the phrase? Pure play, early stage innovation. Is Zoom Video Communications pure play, early stage innovation? Is Roku early stage pure play innovation? Is Shopify pure play early stage innovation? Is Teladoc? CRISPR might be. I don't know anything about Beam Therapeutics. I don't know anything about Block. I don't know anything about Exact Sciences. I can't speak for them. But Zoom, Roku, Shopify, Teladoc, no. They're not pure play early stage innovation. Their big stock promotes because of lockdowns that are now seeing themselves deflate. Because that's one of the conventional misnomers on the markets, is that bubbles pop. And sometimes that's true. But oftentimes what happens is they deflate. And they deflate slowly. And that's what's happening to them. Because it takes a while to get back to the levels when the bubble started going. That doesn't mean that you can't take out half the air in a crescendo waterfall event that wipes out 50% in a week or two. But to be up, to go up 100 needs down 50 to break even. To go up. So yeah. I don't want anything to do with this. I don't want anything to do with cross-asset ownership. I don't want anything involved in her books. Because there's better opportunities out there. And I'm just not interested. Maybe all these rip next year. Damn, they're so oversold. They need to bounce, don't they? At least that's what you think. So what's my plan? Well, people always want to talk every year about the Santa Claus rally, as though it's the thing on the left. But seemingly people have forgotten about 2018, and I'm sure other times other than that. And that's what I'm hoping for. Because even a few days ago, I was eyeballing some things that I was thinking about buying for the portfolio. After all, there's not a lot, there is a lot, but there's not a lot I want to buy with $42. And so I'm hoping for a more homeless-looking Santa to come along and, drop the market to give me some buying opportunities. Because there is entertainment value as well as educational value here. And it's not too entertaining to see a guy sit on cash. And I will sit on cash if I have to. I'm not just going to buy stuff. I want it to hit a point that I want to buy it. And it would be pretty, not embarrassing, but frustrating to viewership and really not entertaining to sit with $42, slowly accumulating $84, so on and so forth, not buying anything. But that will demonstrate an important lesson, and that will happen at some point. Now, the only reason that might not happen is because something somewhere will fall more likely than not and demonstrate some weakness, whether it's an earnings miss or something. And then, since I'm playing with such small sums of money, it should afford me to buy at least a stock. Instead of not bothering with, say, a $10,000 or $100,000 or $1 million account and see something somewhere drop. And I'm like, well, I might take a stab at it, but I really don't want to spend any money on it. Or play such a small position size. If I buy a $60 stock, that's a week and a half's worth of inflows. And that's what I'm trying to set up here as well, is kind of a hedge fund-esque style. You get money coming in. That's one of the problems why hedge funds actually don't do well, along many other reasons, is because when they need capital from their limited partners, the people won't give it up. It's like, no, down 30 isn't when you hit the panic button the panic button to sell. Down 30 is when you give me more money so I can buy low. So thankfully, I'm my only limited partner. So what might I be buying? Well, I have a few ideas. And this is indicative of one of them. In the deepest waters and the harshest environments where you need us to be, we're there. Sounds nice, doesn't it? So they operate off of places like Suriname, Guyana, Brazil, the North Sea, Angola, Nigeria, Ghana, Gabon, or however you pronounce that, Indian Ocean. And I'm not really going to say any more than that. But, so yeah. So, this is a classic meme. And this is the conspiratorial mind that I was mentioning earlier about how things are rigged, which I've always found fascinating, because anybody who ever says that to me, I say, well, if the market's rigged, then that means it has a fixed way of being, or a static way of being, or at least a patternable, predictable way of being. And if that's true, you probably should go figure it out to use that to your tactical advantage. So what's stopping you? But of course, saying that something is just rigged is really a cop-out excuse for them to abdicate any responsibility and culpability to their own deficiencies. I'm not saying I'm going to make any money. I'm not saying anything. I'm saying that we're going to do some things. And maybe I'm the patsy at the table. Maybe I'm the fool. And this will be quite revelatory in real time and demonstrate that, as has happened to so many people on the very first screen. Well, I don't know if it happened to them particularly, but a lot of the people who do these challenges bought all the stock promotes and pump and dumps and Ponzi's and profitless businesses who chronically have to do down rounds, issue shares, or do something to raise capital because they're insolvent. I'm going to try to stay away from those. Yet again, they were great things to buy in the past couple of years. They went up a lot. But the problem is people start buying their own bullshit and believing that they're actually good companies. Just because we can do more medical things on the phone and over videos doesn't necessarily justify the evaluation metrics that were given to things. A treadmill with essentially an iPad attached to it doesn't justify a $40 billion market cap. Yet again, you play the market in front of you, you see it running up, lockdowns happening, you can figure some kind of a simple enough narrative out, you buy in, but you have to get out at some point. And some of the things I'm investing in are not good companies and or good industries to be involved in full cycle. Like, you want to get out of the way because the name of the game is bankruptcy for many of them through these 10, 20-year full life cycle analysis. And those are some of the places I plan on participating in. So, yet again, we'll find out if the market's quote-unquote laughably rigged or if I'm a bad trader. And stay tuned for week 1 episode coming up at the beginning of the year. Thank you.